traditional IRA, Roth IRA. Same contribution limit, same investments inside, wildly different tax bills. Pick the wrong one and you can hand the government tens of thousands of dollars you never had to pay. Same money, same market returns, different account. So here is the actual difference in one sentence. A traditional IRA gives you the tax break now and taxes you when you take the money out. A Roth IRA taxes you now and hands you every dollar tax-free later. That is it. Everything else is detail. But the detail is where people lose money. These two accounts also disagree about who is allowed to use them, when you can touch the money, and whether the government can force you to withdraw it. And the reason you get a choice at all comes down to a piece of budget math from 1997 that has almost nothing to do with your retirement. Stay with me and you will know which one fits you, the income numbers that quietly disqualify people, and the one rule that makes the Roth worth more than the math suggests. Start with the question that decides it. Do you think your tax rate is higher now, or will it be higher when you retire? If your rate is higher today, the traditional IRA wins. You take the deduction while it is worth the most, then withdraw later at a lower rate. If your rate will be higher later, the Roth wins. You pay tax at today's cheaper rate and never pay again. That is the textbook answer, and it is genuinely useful. It is also incomplete. Look closer. It assumes you know your future tax bracket. Nobody does. Tax law changes, your income changes, and Congress rewrites the brackets roughly every decade, so most people are guessing. Which means the tiebreakers matter more than the theory, and the tiebreakers are where these two accounts really split apart. The first tiebreaker is one most people never see coming. A traditional IRA does not always give you the deduction. Anyone with earned income can put money into a traditional IRA. There is no income limit on contributing. Deducting it is a different question. If you are covered by a retirement plan at work, a 401k for example, the deduction starts shrinking. For 2026, a single filer with a workplace plan loses it between $81,000 and $91,000 of income. Above $91,000, nothing. Married filing jointly with the contributor covered at work, that range runs from $129,000 to $149,000. Now think about what that means in practice. You can still contribute, you just get no tax break for doing it. You have created after-tax money sitting in an account that will still tax your earnings as ordinary income on the way out. That is the worst of both worlds, and it happens quietly, because nothing stops you from making the contribution. If neither you nor your spouse is covered by a plan at work, none of that applies and you deduct the full amount. That single fact flips the answer for a lot of households. So the traditional IRA has an income problem. The Roth has one too, and it works in the opposite direction. With a Roth, income does not shrink your tax break. It removes your right to contribute at all. For 2026, a single filer starts phasing out at $153,000 and is completely locked out at $168,000. Married filing jointly, that is $242,000 up to $252,000. Earn above the top of your range and the Roth IRA is simply closed to you. Direct contributions anyway. That word matters. There is a legal side door and high earners use it constantly. You put money into a traditional IRA where no income limit applies, then convert it to a Roth. That is the backdoor Roth. It is not a loophole anybody is hiding. It is routine. There is a catch, and it bites people who have not heard of it. The pro rata rule. If you already hold pre-tax money in any traditional SEP or simple IRA, the tax office treats your conversion as a proportional slice of everything you own, not just the new after-tax dollars. You will owe tax on part of it. So the income limits look strict, and for one of these accounts they are softer than they appear. Here is the difference that actually changes how these accounts feel to own. Money you can reach. Take money out of a traditional IRA before 59.5 and you generally owe income tax plus a 10% penalty. There are exceptions, disability and a first home among them, but the default is expensive. The Roth is built differently. You can withdraw your contributions, the money you actually put in, at any age, at any time, with no tax and no penalty. You already paid tax on those dollars, so there is no further claim on them. Your earnings are a separate story. To pull those out tax-free, you need two things at once. You need to be 59.5 or older, and the account needs to have been open 5 years. That 5-year clock starts on January 1st of the year of your first contribution. Open a Roth in December and you have already banked most of a year. Small detail, real money. This is why people call the Roth a retirement account with an emergency exit. The traditional IRA does not have one. That flexibility keeps going in a way most people only discover at 73. Required minimum distributions. With a traditional IRA, the government eventually makes you take the money out. At 73 under current law, you have to start withdrawing a set amount every year, whether you need it or not. You did not want the income this year? It does not matter. It is taxable when it lands. Miss one and the penalty is 25% of the amount you should have taken, cut to 10% if you correct it quickly. A Roth IRA has no required distributions during your lifetime. None at all. You can leave it untouched until the day you die, growing tax-free the whole time. Think about what that does to the shape of your retirement. The traditional IRA is a loan you took against your future tax bill, and eventually it gets called in. The Roth is finished business. That is the strongest argument for the Roth, and it has nothing to do with predicting brackets. It is about control, which raises an obvious question. Why does the Roth exist at all? Why would any government offer to stop taxing you forever? The answer is a budget trick, and it is genuinely a little absurd. The Roth IRA is named after Senator William Roth of Delaware, who chaired the Senate Finance Committee. It became law in the Taxpayer Relief Act of 1997, signed that August, and the first accounts opened in 1998. Roth and Senator Bob Packwood had floated the idea back in 1989 under a different name. Here is the part that explains everything. When Congress prices a tax bill, it looks at a 10-year window. A traditional IRA deduction costs the Treasury money today and collects it decades later, far outside that window. A Roth flips it around. People pay their tax up front, so revenue arrives immediately, and the cost of never taxing those withdrawals lands 30 or 40 years out, where the scorekeeping does not reach. So the Roth IRA looked cheap on paper precisely because its real cost was too far away to count. The best retirement account most Americans can open exists partly because of how Congress does its accounting. That is the trade. None of which changes the fact that it is a good deal for you. It just means nobody designed it as a gift. So, one sentence to take with you. The traditional IRA and the Roth IRA hold the same money and the same investments. And the only real difference is whether you pay the tax on the way in or on the way out. Decide with your bracket if you can genuinely predict it. If you cannot, weigh the things that do not depend on prediction. Whether you get the deduction at all, whether you might need the money early, whether you want somebody else setting your withdrawal schedule at 73. Get that one choice right, and it keeps paying you for 40 years. I would like to know which way you went, traditional or Roth, and what actually made the decision for you. Tell me in the comments.